Hello everyone, welcome to Decode Indian Markets. In today's video, we are going to dive deep into credit spreads. We'll cover everything you need to know from the basics to advanced strategies, and we'll also look at detailed payoff charts to help you understand how they work in real scenarios. So, let's get started and decode the world of credit spreads together. Now, the first question is, what is credit spread? So in a credit spread, basically you sell an option, which means you are collecting premium, and you buy another option at a different strike price, which means you are giving premium, right? Here you are collecting premium, here you are giving premium. So overall, since the option you are going to sell will be at a higher price and buying option will be at a lower price, lower premium. Okay, so in overall, you will receive a net credit when opening the trade. So if the spot is out of the money or doesn't move much or moves a little, then in that case you get the theta decay and you get the net credit, which is the profit you get, right? Here you have you have defined risks and defined reward. So you know how much you can lose and you know how much you can gain from the moment you take the trade. Now there are two types of credit spread. One is bull put spread and the other one is bear call spread. Now, bull spread, bull put spread, as the name suggests. So if you are bullish, if your bias is towards upside, then in that case you will form bullish bull put spread. So in this case you have bullish side, and you are going to create legs with the put strikes, put options. You are going to sell put option and you're going to buy put option, and spread is having multiple legs, more than one legs. Okay, so you sell a put at a higher strike and buy a put at a lower strike. So you sell a put which is of higher premium and you buy a put which is at a lower premium. Both puts have the same expiration, so both will expire on the same date. In that case, this is what we call a bull put spread. We are going to see this in the chart, payoff chart, and we will understand how this works. Similarly, bear call spread. So in this one, bear, you have a bearish view. That is, you have a view of downwards. You are biased towards the downside of the market, and you will be creating legs on the call side. So you will be selling and buying call options to make this spread, which is more than one leg. Now you will be selling a call at a lower strike and buying a call at a higher strike. So this is strike price, but at the end, sell a call at a higher premium and buy a call at a lower premium, and both call have the same expiration, right? So overall, you will receive the premium. That's why it's a credit spread. Now, how credit spreads generate profits? How you get profit? As I explained you sell at a higher price, which is here. If you see, you sold at rupees 100. You sold a strike price of 100 for rupees 3. 3 is the premium and this is the stock price going on, and you sold it for rupees 3. Now you are buying 95 strike for rupees 1. So you sold at 3 rupees and you bought for 1. Net credit would be 3 minus 1 rupees, which is 2 rupees. So you get 2 rupees if the market goes in your favor. Your favor in the sense, if you are bullish, then you will be having a bull put spread, and if you are bearish you will be having a bear call spread. So if the market moves a little up or uh, stays there itself, then you will be making profit from bull put spread. If you are bearish, if the market moves downwards or stay a little bit downwards or stays there or moves completely downwards, then in that case you will be getting net credit from the bear call spread. Now, so when do we use the credit spreads, right? When do we use these credit spread, bull put spread and bear call spread? So when you expect that the stock would not move really fast, it is not going to rally, or you don't know how much time it is going to rally. It will go up, but I am not sure when it will go up maybe in a week or two, but it will not move very fast. I know this thing. So in that case, you will use this credit spreads. And IV is high. You want to sell premiums because when the IVs are high, the premiums will also be high. At that In that case, you will be able to make more profit. You want income with defined risk. So here the risk is defined. You will when you take the trade, you know how much you can lose. So when you directly sell an option, in that case you don't know how much you can lose. It the risk is unlimited, but here you will have a defined risk, and the probability of profit in this credit spread, it is also high. Probability of profit is high. Now advantages, again, defined risk. You know the maximum loss you can get and the maximum profit you can get. Income generation, you receive money upfront. So since it's a credit spread, you will be able to earn money if the market moves a little or uh, no movement at all. Then also you can receive money from this spread. Then probability of profit is high. Then time. So probability of profit is high is because the time decay works in our favor, right? And can be placed far OTM for safer positioning. So it can be done at the money. You can create these spreads near the strike. So at the money as well near ATM, and you can go for OTM options to have a safer side, uh, less risk. We'll see that in the payoff chart. Now there are certain disadvantages. So profit is limited. Since we are trying to minimize the loss, the profit also is limited. We'll get a little less profit. Large adverse moves can cause maximum loss. So if the market moves in the opposite direction, what we are expecting, in that case we can see a big loss, because we are getting premium. We are basically earning from the selling leg, and the selling leg can go to any price, and that's what, if we do not have a stop loss, we should have a stop loss. In sensible, we can have a conditional exit. If we do not have the stop loss, in that case we can have a large loss, like how we have in option selling. Requires good management around expiration and volatility. So if the volatility is high, then in that case we have to see how the premiums are. Premiums should not go up and down, so we have to see that it's not happening, right? uh, so yeah, let's trade. Let's see the chart now. Okay, so I have Zerodha account and I use Sensible for trading. So let's see in Sensible how we can create credit spreads for both bullish and bearish bias. Let's see Nifty. Okay, so for example, I have to take a trade for this upcoming month, and my view is um, bearish. Okay, my view is bearish. You can see here 26,000 is the strike price, which is the current resistance level, and then we have a resistance level around 26,100. 26,100 is the next resistance level, 26,000 is the first resistance level, and my view is downwards. You could have a different view. You can have a view of upwards, but at this point my view is downwards. So what I'm saying is that the market should either stay here, like either it will close below 26,000 or at 26,000 max. It should not go above 26,000, and the speed can be like fast or slow, it doesn't matter. Basically, I'm expecting the market should expire below 26,000. In that case, my view is downwards. So what I'm going to do is, if I have to, so if I have to say my view is bearish, right? So in that case, what I will do is bear, and since I have to make profit from the selling leg, so for bearish trade, I will be selling a call leg and buying a call leg itself with a little lower premium. and I'm going to have two legs. So I'll create a bear call spread, which basically means that my direction is downwards, right? So let's go and create this. So we have already some option strategies inbuilt here. So so my view is bearish. We go here, we see bear call spread as we have bear call spread. So we go here, bear call spread. Don't get confused with bear call spread and bear put spread. Okay, the way you have to think is using how we have. So my view is bearish, so bear, and since we have to make profit from selling because it's a credit spread, so we have to sell a leg. So if we sell call option, then only we can get premium. So we have to sell call option and buy call option with a little less premium, which is trading at a little less premium. And then spread is I'll be using two legs here. So let's go here, bear call spread, open in builder. Okay, so this is what sensible is giving me, bear call spread. This is what I'm looking for. So what I'm saying is, if you go to here, so I'm saying if the market stays at 26,000 and below, then I should make profit. So if you see here, what we are doing is we are trading for an expiry of 18th November. You can choose any expiry, 25th November, 10 days from now, 17 days from now, or 24 days from now. So you will have uh, uh, difference of days here, 25th November 10 days to 2nd December 17 days. So for example, I'm saying in the next 10 days my view is that it will not go above 26,000. So if you see here 26,000, this is our payoff chart, right? So this is my 26,000 strike price now, 26,000. So if you see 26,000, I am having on the expiry date 308 rupees loss, right? So if I'm saying that the my view is bearish and the market should go downward, so if I say that it should close below 26,000, so as soon as it goes below 26,000, it is giving me a profit and there is no loss here. If it goes above, then also it is giving me a 17% loss. This is which is fixed. You cannot lose more than this because you are selling a strike of 25,900 and you are buying a strike just above 200 points from this strike, 26,100, and both are call side. So the premium which we are selling is 234, premium which we are buying is 138, and if you calculate this, how much we are getting from it, which is 234 minus 138, around 96. Around 96 rupees you will get from here, and in one lot of Nifty we have 75. uh, so you can multiply 100 into 75, almost like 7500. So that's what we are seeing here, right? Expiry date, you get 7,193 rupees, which is almost, so I have not done the exact calculation, but it will be approximately like this only. Okay, because it is not 100, it is 94, so it will come little less than 7,500. So if you go below 26,000, you will make profit. So if you want to reduce this risk, then what you can do is, so this buy leg is basically a hedge. What you can do is you can come near this. Okay, so if the difference we are making is 100 points, your profit will also decrease, but at the same time, if you see, I'm having only 3,600 loss maximum. If the market tomorrow opens 300 points gap up, then also I will not lose more than 8%. More than 3,600 I'll not lose. If you want to still decrease this, you can come more near to this and you will lose only 4.2%, but you will gain less profit as well. So if you are very very sure, you are 90% sure that it will go down, okay, according to that you have to take trade. And we had talked about taking out of the money also. Out of the money in the sense, so suppose market is going at 25,910. What you can do is, this is at the money, we are selling at the money. you can go up, you can go and sell for 26,100, and you are buying at 26,150, or you can buy at 26,200. So in that case, you will be making profit if the market closes 26,000 below 26,100 as well. See, you are on the safer side. And the probability of profit in this trade is 64%. The probability is also high, more than 50%. And if you uh, come closer to this, you see 62%, and a maximum loss has decreased 5% loss, and maximum profit is 3.8%. So there are more chances of you making profit. If you increase the strike price more, probability of profit has increased to 71%. So that's what, if you go out of the money, your probability of profit will increase. You can have a maximum loss of this one, but since you, if the market expires here also and it moves in the opposite direction a little bit up as well, like for example here, if you see 26,170, 26,200 also, and then also you will be in profit. So if you go here, Nifty, so if the market moves 26,200 as well, then also I'll be in profit in this strategy. And the only thing is that capital used here is 43,794 margin used, and you will need approximately like 50,000 for this to trade the strategy, and you will gain 2,000 rupees from here. If the market moves downside, you can, the downside is already covered, but upside you're covering 200 points. Your break even is at 1.2% upside, which is a very good break even point. And probability of profit is 71%, which is very good. Risk reward ratio 0.41. So overall, this is a very good strategy. Similarly, we will see for a bullish bias, right? So for bullish bias, we'll use a bull put spread. So if you go here and use right, so your view is that the market will, this is the support or last support. You can make this as support or this as support. Let's assume this as the support, 25,700. So my view is bullish. What I'm going to do is, my view is bullish, bull, and I'm going to sell. I'm going to make profit from the credit by selling a put leg and buying a put leg. So we'll use put, bull put spread. So this is bull put spread we'll be using. So here my view is upwards now. Let's remove this to avoid confusion. Bull put spread. So what I'm expecting is, if the market stays 20 at 25,700 or above, then I should be in profit, and I should have a loss if at all it goes down, right? So let's see that this is bull put spread. What is the strategy builder? So if you see here, this is a strategy builder. We are selling a strike for, let's do it for 25th November, because we are expecting in 10 days it will not go there. So we are selling a strike price of 25,900, and we are buying 25,700. So what we have to do is, since we are saying that the market will stay above this, but if this the automated strategy which Sensible gives me is for add the money. So if the market comes at 25,700, I'll be in loss. If you see here, 25,700, I'll be in loss. So what I have to do is, I have to go out of the money. Out of the money in the sense, I have to come here, 25,700 I have to sell. So if 25,700, I'm in profit, right? So I have to sell out of the money to make profit. And if it goes below 25,700, then only I will have loss, and the loss is also fixed, which is 25%, and profit is 2,820, 6%. Probability of profit is very high, 75%, which is a very good probability of profit. So that's how you can create credit spreads for both bearish and bullish point of view. You can change these strike prices, play around. If you want to have less risk, you can keep a difference of 100 points. So if you see here 13% loss only, you can keep a difference of 5 points if you are not expecting much profit. So here you will get only 870 rupees, which is like 2%. 2% of your capital you are getting, that which is a very good return, 2% in 10 days, right? And probability of profit is 73%, which is a good probability of profit, right? So yeah, this is all about credit spreads. Thank you so much for watching this video. Please like, comment, share, and subscribe the channel for more such videos.